Welcome to another webinar for the Return Stack Suite of ETFs. My name is Rodrigo Gordillo. I am president of Resolve Asset Management and co-founder of the Return Stack Suite of Funds. Today, we are very fortunate to have Corey Hoffstein, CEO and CIO of Newfound Research and fellow co-founder of the Return Stack Suite of Funds. And if you haven't already heard of the Return Stacked lineup before, ultimately, what the suite aims to do is to unlock the benefits of diversification by allowing you to introduce alternative investment strategies and exposures into your portfolio without having to sacrifice your core stock and bond exposures. Each fund in the suite is actually designed to have a simple formula. So $1 of a base allocation to stocks or bonds and another dollar of a diversifier on top. We launched our first fund in the US back in February 2023, and we are lucky enough to say that the whole suite has grown to just around $1.4 billion in assets under management since. So clearly there is a demand for this solution. We're seeing demand not just across the ETFs that we'll talk about today, but across our whole lineup. And so what are we going to talk about today? What we wanted to focus on is our US stocks and managed futures ETF, ticker RSST, and our US stocks and futures yield ETF, ticker RSSY, both trading on the CBOE exchange. And in particular, we're going to highlight the last 12 months because since it's been a pretty amazing run for these strategies the last 12 months, and we have had a deluge of questions about why and what are the drivers and how have we done so well. And we don't necessarily like to really delve or dwell too much on recent performance. We know that this is a long-term game. We're trying to capture a risk premium over time, but we did feel like it gave us an opportunity to really dig deep into each individual strategy, why they're different, why they're complementary, how they work together between carry and trend, and also how they're complementary to a bond and stock portfolio. Understanding that, look, the last 12 months have been fantastic. The previous 12 months were a complete opposite of that. But over time, and these factors that we are stacking on top, an expectation going forward to us is it going to be a slight, excess return over time, even though the results in the last 12 months have been pretty stellar. So with that said, I want to make sure that everybody here feels free to ask questions along the way. So if there's, I'm going to be reviewing all the questions. I might interject Corey and ask him in the middle of the presentation, or we may push it out to the end. But please feel free to ask us any questions throughout the presentation as you want. But before you ask questions, I would like to start by asking you guys a question. And we're going to do a little poll here, just to get a sense for who we're talking to and how much time we're going to spend on each factor. The question is, who here is currently investing in just managed futures trend, just futures yield or carry, or both? And then, of course, the one that I don't want to see too many people clicking on is neither. But those are your four options, and maybe give you guys about 30 seconds to respond and get a sense to how we want to focus this presentation.
Not leading the audience at all with that last comment there, Rod.
It's okay. You can tell the truth. My feelings won't get hurt.
Now, Rod, does it count if they're stacking these?
Oh, we never gave them an option to stack. It's choose one only. Okay. So not surprisingly, those numbers are interesting. So we have 43% of members are presently allocating to managed futures trend, 2% to carry only, okay, and then to both we got 32%. That's good, and neither is 23%. So hopefully we get an opportunity here to plead the case for these diversifiers as a decent stack. Okay, Corey, I am going to pass it over to you. You can give us a little bit of background on what's happened recently and how we should think about it.
Well, thank you, Rod, for that warm introduction, and hopefully you'll get your power back on and you can jump into this webinar, and I'll do my best to hold down the fort as best I can. As mentioned, please ask questions along the way. Rod will be taking a look at those questions. He can pop back in and ask me them in real time when and if appropriate, or we can hold them to the end. So as Rod mentioned, this has really been a standout 12 months for the return stacking concept in particular in these two ETFs, RSST being our return stacked US stocks and managed futures ETF, and RSSY being our return stacked US stocks and futures yield ETF. And we'll go into the exact formula of sort of how these ETFs work. But what we wanted to do with this webinar was break down where these returns came from, because we know that each of these share a common component of the S&P 500, but they both then added anywhere between 18 and 26% return on top of that. And the question often comes from, well, these are strategies that are trading similar instruments. Did these returns come from the same place? Are these redundant strategies? Are they better held together? And so what we really want to do here was take the opportunity to really disaggregate where returns came from and provide as much transparency as we could as to what's ultimately driving returns in these strategies and try to set some expectations going forward. So again, for those who are maybe a little bit less familiar with what return stacking is, I'm going to do a really brief introduction. So in a traditional portfolio, when you invest a dollar into a fund, you typically get a dollar of exposure, whether that's a dollar of exposure to an asset class like equities or bonds or commodities, or a dollar of exposure to a strategy. Maybe it's managed futures, maybe it's carry, maybe it's merge or arb, some other active strategy. The concept of return stacking is to say, well, what if we take that dollar and continue to provide you a dollar of exposure to the base core assets you know and love, things like the S&P 500, and then also use the capital efficiency provided to us by things like the futures markets to add a layer of another strategy or asset on top. So in the case of RSST, right, we give you S&P 500 plus managed futures trend on top. In the case of RSSY, we're going to give you S&P 500 plus managed futures carry on top. More important than what is why do we do this? And I think last year was a good example of one of the core reasons why, which is, well, we think it's probably one of the best ways to try to seek outperformance relative to core stocks and bonds over the long run, right? We've all seen the historical evidence that shows that trying to pick stocks and add alpha is extremely difficult. Same fact is true within the bond market. And so our argument is, well, what if instead of trying to find alpha within an asset class, what if we just buy that asset class? What if we just buy the S&P 500 and add an additional layer of returns on top? And if we're thoughtful about what we add and we believe not only that it's uncorrelated but has positive excess returns, we think that could be incredibly accretive, not only in portfolio risk composition, but also total return over the long run. That's historically been called portable alpha, right? You're porting alpha from another source on top of the core stocks and bonds in the strategic portfolio you know. We also think another really important second reason is because it solves what we call the funding problem of diversification. And I'll keep this one pretty short, but most investors are starting with a core stock bond portfolio. And to add something like managed futures or to add something like carry, they first have to sell their stocks and bonds. And to sell those stocks and bonds, you have to ask a whole lot of questions like, how much am I selling? What's the impact on my portfolio? What's the impact on expected returns and volatility and tracking error? Some very numerical concerns, but it also invites potentially a lot of behavioral concerns, which are you're selling something that the end investor tends to love and know, and then you're adding something back in that maybe they're less familiar with, that you're hiring explicitly because it's going to zig at the time that the underlying stocks and bonds are zagging, and that can lead to some really uncomfortable periods of return that can make it very hard to make diversification a sustainable part of your portfolio. And so by instead of having this either or decision, by allowing us to stack the diversifiers on top, we hope to solve that problem, both from a return perspective as well as a behavioral perspective, right? So what do we ultimately seek to provide with these two ETFs? Well, first and foremost, we seek to maintain equity exposure, right? For every dollar you give us, we want to give you a dollar of large cap US equity exposure back. And then we want to add a diversifier on top. Managed futures trend, managed futures carry. We'll get into those in a little bit. This is, again, not an either or decision. We want to do it on top and do all this within a daily liquid ticker with single ticker with daily liquidity that you can trade in and out of as freely as you want with transparent pricing and transparent holdings. what are the trade-offs? What do you give up with this methodology? Well, when you get the S&P 500 and you add another strategy on top, even if it's uncorrelated, it tends to be more volatile than if you weren't adding anything on top, right? If you take something like the S&P 500, which has a vol of 14, 15, 16 historically, and you add something on top like managed futures trend, which has a vol of 10 to 15%, you're going to end up with a composite product that has a volatility probably near 15 to 20%, right? You're not adding their volatilities together. Diversification really does come to help, but it's typically going to be a bit more volatile. Might look more like a concentrated growth equity portfolio, for example. You're also going to end up in situations where you have drawdowns that don't track stocks, right? That thing you're adding on top is going to have its own idiosyncratic drawdowns. And sometimes maybe equities are flat and your diversifier loses some money and you're going to be in a drawdown when the equities aren't, right? That's just the name of uncorrelated. Again, we think it's a long-term benefit, but the short-term can be a little noisy. And with that, specifically, not just drawdowns, you're going to have some tracking error, right? But that's true for any active strategy, right? Whether you buy S&P 500 value or momentum or quality, or you tilt, into some growth, or you tilt into some small cap, all of that introduces tracking error relative to your large cap benchmark. This is going to be no different. I would actually argue this is much more transparent because the tracking error is very specifically due to the alternative you're stacking on top. So let's talk about RSST and RSSY themselves. I sort of danced around them, right? Let's dial specifically into them. RSST is the return stacked US stocks and managed futures ETF. The idea here is that we are going to give you $1 of large cap US equity exposure plus $1 of a managed futures trend following program for every dollar invested, right? So S&P 500 base, every dollar you invest, you're going to get $1 of S&P 500, as well as $1 of a systematic trend overlay. That systematic trend overlay is going to go long and short. Here we say 27 global futures markets. It's actually now up to 33, and we'll talk a little bit about that at the end. But long and short global equity indices, bonds, currencies, commodities, and those commodities include metals, energies, and agricultural markets, right? So a well-diversified trend program, trend following, pretty simple concept going back to the 1970s. You want to go long the things that are going up, short the things that are going down. That flexibility has made this strategy historically incredibly resilient in a variety of different market environments and a tremendous complement to core stock and bond portfolios. RSSY. This is our return stacked US stocks and futures yield ETF. RSSY, for every dollar you invest, we're going to give you $1 of S&P 500 exposure plus $1 of a systematic managed futures carry strategy. This one is a little more difficult to disentangle. I think maybe the easiest way to think about this is that when you have a trend strategy, right, for every market, you're going to go long stuff when the trend signal is positive, and you're going to go short stuff when the trend signal is trend signal is negative, excuse me. In the managed futures yield strategy, basically and I'm oversimplifying here, and this product really deserves its own deep dive, but you're effectively going to go long stuff that has positive carry and short stuff that has negative carry, right? Carry is going to be the return you expect to earn if the underlying price doesn't move. So you can sort of think of it as maybe the dividend yield on stocks or the coupon yield on bonds. Every market, whether it's currencies or energy futures or metals, they all have carry, most of which can be extracted from the futures yield curve, hence the name futures yield, or excuse me, the futures curve. And so we extract those implied yields and we basically go long or short based on the carry. Very different signal. I think a lot of people think of trend as sort of being akin to momentum investing in equities. Not quite right, but sort of like, again, price driven, things that are going up, you want more, things that are going down, you want less. Carry might be sort of tangentially more like value, right? And so we think of these things as being tremendous complements. And often when you see managed futures managers, they have historically included both trend and carry into their programs because they have historically been such great complements. Now we want to talk about specifically what happened over the last year. And I think when you talk about the last year, you talk about a ton of macro movement. This is a period where a lot of things happened and there were a lot of persistent not necessarily predictable, but persistent trends that emerged that allowed these strategies to continually generate a profit, right? So you had very strong base performance. So right out of the gate, right, when you talk about a strategy like RSST or RSSY, and you say over the last year, the S&P 500 was up nearly 30%, well, that's the core foundation of return we start with, right? The whole idea here is we're not giving up that base. You invest $1 with us, we're going to give you $1 the S&P 500. Great, right out of the gate, both are starting up, hopefully around 29.8% if we do a good job replicating that S&P 500 exposure. Then when you look around what happened in markets, right, you had tremendous returns in gold, tremendous returns in silver. You had incredibly volatile energy markets, big positive swings, big negative swings over the last, call it 6 months, based on the conflict in Iran and the closure of the Strait of Hormuz. You had the US dollar weakening against foreign currencies, and you had 3 rate cuts into the end of the year, right? A lot of macro activity that created the opportunity for both trends to emerge and persist, as well as carry opportunities to try to harvest some of that, the tailwinds of the yield that you could be sitting in these positions. So what we wanted to do with all this in mind is look at each strategy and say, how can we decompose the returns of these strategies into their core drivers? What actually generated the returns we saw? We obviously captured the S&P 500 return, but okay, where'd the extra 20% come from, say, in trend? So that's what this graph shows in particular. And I'm going to take a minute to really try to carefully explain. What we did here is we looked at the target weights of our trend following model every single day, and we computed the return that the market gave us on that day in each of those markets based on the weights we had, right? So if we were long something and the market went up, that was a positive contribution. If we were long something and the market went down, it was a negative contribution. And then we split those into the individual sectors. So for example, gold, silver, and copper, all their returns got lumped together into the metals sector. The equities you can think of as the NASDAQ and the S&P 500 and the Nikkei and the German DAX and the FTSE 100. Those all getting lumped together. Similarly, energies, you've got nat gas, Brent, WTI, a whole bunch of other, RBOB, gasoline, all that's getting clustered into energy. And then what we did is we tracked that cumulatively over time. So what can we see here, right? And all this should add up to the total gross return of the strategy, net of fees, and net of transaction costs over the period. And what we can see is that certain asset classes were standout winners, certain asset classes were losers. I want to start actually at the bottom here with bonds, because bonds is one of these asset classes that if you looked in the 2010s, I believe it was one of the best drivers of returns in trend following strategies. We have seen the exact opposite in the 2020s. Bonds has been actually one of the worst drivers of returns. It's been a period of persistent whipsaw. And you can see sort of a slow bleed here. Bonds were just a slow negative contributor to returns, constantly sort of taking returns away. Saw that similarly with currencies and similarly with energy until the Iran war, at which point energy had a strong pop. Trends started chasing prices. Trends probably got a little bit over their ski tips. And then as things have subsequently wound down, though this does not include recent June movement, right? Energy ended up reverting back to being a near zero. What you see the primary drivers being, though, especially coming out of the tariff tantrum from April 2025 and seeing really strong persistent trends, were equities, right? At about 14.5% cumulative contribution, as well as the metals. And again, I mentioned that gold, silver, copper to a lesser degree, but gold and silver both went on an absolute tear into Q1 2026. I do think one of the important things I want to point out here in particular is gold and silver have had dramatic sell-offs since their peak, right? One of the ideal benefits of trend following, especially volatility targeting trend following, is that as those positions begin to roll over and as they get more volatile, those positions will shrink in size. And so you can see that even though gold has had, I believe, close to a 40 to 50% drawdown from peak. Maybe it's closer to 30, and silver is the one that's near 60. You can see that the metals contribution, while it did sell off since the exact peak in late January, has more or less flatlined as we've muted those positions considerably. But the important point here being is that metals and equities were persistent contributors over time. And so when we look at RSST versus, say, the S&P 500, and we look at just the cumulative return of trend over this period, trend was a very persistent additive feature over this year. We're going to see something very different with carry. And a lot of the story here can really be broken down into two assets, gold and oil, right? Because what we saw with trend is that we were very, very long gold and the metals, and they were one of the persistent winners. Equities as well, but the metals were a lot of the story over the last year. That was not the case in carry. And carry kept trying to get long energy. Carry certainly did not predict what happened in Iran, but carry, in looking at the futures curve, kept saying, well, we want to be long oil because there were concerns about, say, prompt supply. That ended up being a very acute concern that drove prices to nosebleed levels, obviously in Q1 and Q2. But really, this is going to be the big differentiator when we look at the returns of carry. Like, gold was the driver for, in large part, in trend. We're going to see that oil and the energy complex was really the driver with carry. And so what that means is when we talk about the correlation between these strategies, well, over this period, the correlation of whether they are additive to each other or reductive from each other is going to be largely driven by, what happened with gold and oil. They were uncorrelated to each other. And then as the Iran conflict drew on, they became actually more and more negatively correlated to each other, which was an interesting feature that was sort of an emergent feature during this period. So I want to look at the same chart for carry, right? And we see something a little bit different. We see a similar total gross return. Again, this is not net of fees. This is not net of transaction costs. But what we see as a big difference is that this was not a persistent positive return that was being generated. In fact, just the opposite. It's largely noise for, call it, the first 7 or 8 months of the underlying returns. And then really, currency helped. You can see sort of currency took off in this light green line, in this year, but it was largely an energy story. And as I mentioned, we don't look at this and say, well, that's because futures markets predicted what was going to happen. We saw flip-flopping in the energy markets going back into Q2, Q3, Q4, 2025. There was supply risk, and then what happened with Venezuela, and you just saw the curve flip-flopping around trying to figure out, well, were there issues, were there not issues? What became very clear is as soon as there was any conflict in Iran is, yes, there was absolutely prompt supply risk. Nobody knew when the strait was or going to be open, how many ships would be able to get through, what the impact, long-term impact on the energy market was going to be, what the U.S. policy was going to be on drawing down our strategic reserve. And so all that created a lot of uncertainty in the energy futures curve that made us ultimately be long. Now, what then happened is that as those positions got more and more volatile, our strategy naturally compressed their exposure because we're trying to create balanced risk within the portfolio. So we got a nice initial pop, and then our risk-adjusted weight to these exposures continued to come down and down, and we reduced our notional exposure, our notional weight. And we'll talk about that in a little bit. We've got some new features of our website we want to point out at the end of this. But I want to highlight a lot of carry's return was not because, the same persistent returns that came out of trend, but rather because we had this exposure to energy. And as the risk materialized, we were well compensated for bearing that risk, right? Again, we were holding long the front month futures contract with the risk being that any day there could have been some sort of deal announced or some sort of anything that could have driven prices down dramatically. And we saw that a number of times in these 10% pullbacks, and then energy would run up again. That is the risk that we are being compensated for in being long those front month futures during those positive carry periods. Now, a lot of the questions we get with these two strategies in particular is, well, if this is like, say, again, akin to value and momentum, does it make sense to hold them together? Like, aren't these just naturally offsetting positions? And I think maybe the one analogy to provide here is sort of just thinking about like equities in particular, right? When equity trends are really positive and the price keeps going up and up, right, that's going to lead to a positive trend in the trend program. But unless the fundamentals are growing as well, when you look at what is carry in equities, well, carry is largely the dividend. Well, if price keeps going up and up and up and your dividend expectations aren't going up, it means the dividend is going down and down and down, and the carry signal is getting weaker, sometimes if not going outright negative, right? And so then the question becomes, well, aren't these just offsetting ideas? Like if you've got momentum and you've got value in theory, like shouldn't these things just be canceling out? And so the next cut we're going to look at, and this is sort of the most technical, but I think it's maybe I just like it because I'm a technical person, is looking at saying, well, what happens in the internal returns when these programs agree, and what happens when they disagree, right? So I'm going to try to explain this very, very methodically because it's a little bit complex, but there's three lines here, right? And the light gray line basically tries to capture the returns based on weights, underlying weights that they agree on. And then the green line is going to be where carry disagreed with trend. And then the black line is going to be where trend disagreed with carry, right? So let me give you an example. Let's say carry said, I want to be long 5% gold. And trend said, I want to be long 10% gold. They agree 5%. Carry then has no disagreement. It says, yeah, I agree up to 5%. Gold says, well, I disagree. I think it should be 10. I have an extra 5%. Right? So the agreement sleeve would say, yep, we got 5% gold. Carry disagreement would just be 0 on gold. Trend disagreement would be, we want another 5% gold. Let's say carry says we want to be 5% long oil. And trend says, well, we want to be short 5% oil. What you would say is there's 0 agreement. So there's no contribution to the agreement return. Carry would be a plus 5% weight in oil. Trend would be a negative 5% weight in oil. And every day we come up with those weights, where they agree and where they each disagree. And then we run the same exercise, which is let's take those weights, take the returns of the markets over that day and plot the cumulative equity curves. And what we would expect is that if these things were really negating each other, the disagreement curves would go down and the agreement curve would go up, or vice versa if you were looking at a period where these strategies didn't do well. But what you see here is actually just the opposite, which is, well, the agreement curve went up, which is great, right? But both disagreement curves also went up. So where they agreed made money and where they disagreed also made money, which can be a little confusing. Like how can they disagree with each other? And the answer really comes into, well, the weight in which they disagree and the timing in which they disagree, right? So carry this whole period largely was short gold, but it was not as short gold as much as trend was really long gold. Trend had a very strong risk-adjusted weight to gold and silver. Carry didn't like gold and silver. It thought it was a bit over its ski tips. It was short gold and silver, but not in massive size, right? So even though that was a drag on carry's disagreement, it made way more money for trend's agreement and did way sort of less damage for carry's disagreement. Conversely, trend was not particularly long energies going into the Iran crisis and the Iran war. Carry was, and so you see this huge carry disagreement pop during that period, and actually it's what made RSSY so resilient during that period where trend wasn't. And so again, these are not conflicting signals. Over the long run, the correlation between trend and carry is quite low. And even though it might seem like the price return element of that is common to both of them might cause them to have different signals, often the weights and the when leads to, ideally over the long run, we would see all three of these go up. Now, as Rodrigo alluded to at the beginning, like this is not how it always works, right? This was a good period for both of them. If you rewound the clock to the prior 12 months, where they agreed went down and where they disagreed went down. It was one of the worst periods for both trend and carry simultaneously. While they had zero correlation, looking at them 50-50 would have just led to a straight line down because of that zero correlation. But that agreement, disagreement part, again, I think is really important. The intuition a lot of people have is these things just negate each other, and that is not what the empirical evidence suggests, nor I think the theoretical evidence really suggests when you dive into how these strategies are constructed. So just to sort of talk about that correlation profile over time, what we're looking at here is the rolling correlation between the S&P 500 and trend, S&P 500 and carry, and trend and carry, right? And ideally over the long run, these are all near zero, right? But what we know about both trend and carry is that they are directional strategies. They can have positive beta to equity. They can have positive beta or negative beta to bonds, currencies, commodities as a general sector. And so when equities were doing quite well and had positive trends, you can see that trend and carry generated a positive correlation. And then as equities have sort of, as other things have sort of taken over, trend has gotten less and less correlated with equities. Trend and carry were very negatively correlated in early sort of mid Q3 last year, and then basically went near zero correlation. And then S&P and carry, right, were almost no correlation, but then oil, right, the large oil exposure that we saw in carry being so negatively correlated to equities over the last several months led to a much more negative correlation between carry and equities. I point all this out only to say our expectation over the long run is that these things are largely not correlated on average. In any given moment, they can be quite correlated both to each other and the underlying market. That is a feature, not a bug, right? The idea here being, if trend is highly correlated to equity, it's because trend thinks equity beta is worth holding or something correlated to equity beta, right? You can get that beta through other markets as well, whether it's currencies, rates, or commodities. But the point is, the signal is telling us we think that that's accretive value, and so the program is going to be all right taking that same risk. Similarly with carry, whether it's positive or negatively correlated, like this is a feature, not a bug. We're not going for persistent zero correlation. We're going for correlation over the long run and letting the feature dictate when we should be long, have positive correlation or negative correlation based on whether we think that positive or negative carry is there. So now I want to talk a little bit about the combination of these things. I hope I've sort of convinced you that there is these things are not conflicting positions. That trend and carry trade these markets, but do so in different, unique ways. And ideally, trend and carry both generate a positive excess return over time. In being lowly correlated to themselves as well as the underlying market, we think there's incredible value in diversifying. So what we have plotted here in the gray line is the S&P 500 over the last year. In the blue line is RSSY, the black line being RSST, and then the green line is a portfolio that started 50-50, was allowed to drift until end of year, reset till 50-50 between RSST and RSSY again, and then has drifted ever since. And sort of the thing I'll point out is again, we know looking at the analysis we looked at that trend was sort of a persistent outperformer relative to equities, but it did not particularly pop during the Iran war period. And so what you see is this black line generally outruns the gray line, but it doesn't do much during that to stave off losses when equities sold off in early Q2. RSSY, on the other hand, we know didn't do much for the first 9 months, right? It just sort of was noisy. And so it tracked more or less the S&P 500. I think what's important here, again, going back to this whole return stacking concept, is while it went nowhere, there wasn't an opportunity cost to having gotten out of your equities to buy this, right? You didn't have to sell the equity exposure that was up 10, 15%. You got that return plus some noise around it while carry did nothing. And then you were able to have carry in your portfolio, which did exceptionally well during this period because of energy exposure, right? You can see this is where equities sold off in March, April, and you can see RSSY continued to march upward incredibly quickly, while carry had incredibly strong returns over that period. And then the combination of sort of that 50-50 RSST, RSSY portfolio just led to, as we would expect from lowly correlated strategies, just a more persistent, consistent outcome. And we see that in some of the numbers as well, right? So we can see, excuse me, the total return over this period. We can see their volatilities and their max drawdowns, as well as tracking error to the S&P 500, right? And we can see that RSST, RSSY, as expected, the 50-50 combo sort of lands in the middle from a total return perspective. But we're sort of better off from a vol perspective, closer to where RSSY was than where RSST was, which was running a little hot over this period. Because again, that low correlation of between trend and carry helped keep the vol down. Ended up with a max drawdown that was lower than the max drawdown of either, right? Which I think is a really important feature here, because these max drawdowns happened at different periods. This helped keep the total max drawdown lower, and then a tracking error to the S&P 500 that is lower. This tracking error of this 50-50 combination is very similar to the tracking error you would see of, say, like the MSCI US Value Index, or the MSCI USA Momentum Index, or the US. So like it's sort of, when you combine the 50-50, each individually is a little bit higher, call it 25% higher. But when you combine them, you get to a tracking error that is historically quite similar, or like the Min-Ball Index, quite similar to large cap US factor indices. And I think it's a nice feature to have when you think about building these portfolios. You can think about saying, well, I'm getting my equity beta and a totally unique return stream added on top. This combination I can just sort of think of as being like another equity factor in a way. But instead of trying to reweight stocks, I'm trading all these futures markets on top with totally different and unique signals, hopefully creating totally uncorrelated returns versus what we would see with traditional factors. So Rod, as we sort of go through the necessary performance, quotes here, standardized performance, maybe now's a good time to turn it over to some questions, and then we can sort of highlight some of the features on the website that people might not be familiar with.
Yeah. So I think
You're back.
I'm back. I'm fully back. Look at all that light.
Wow.
So much power. So why don't we talk a little bit about where people can continue to create intuition. Oh, well, maybe you're gonna go through those disclaimer slides, but why don't I just go through a couple of questions that I can answer briefly? There are a few questions on requests about what's the ideal allocation. Sadly, we cannot give that type of advice over a webinar, but there's tons on our website in the blog post that can help you kind of ideate on what is ideal for you in your situation. There are questions here about the type of reversal that we have seen, or the trend can experience during a massive equity bull market, when equities turn around and trend gets caught up in that. And the question really is carry also susceptible to that type of period where equities do well, and then there's a reversal in equities, and equities gets hurt. And there's also a question of a separate question, whether carry itself is susceptible to what everybody believes carry to be, which is, being basically short volatility. I think you addressed a ton of that already. There is, why don't we tackle trend first, and then we can talk about carry. I think a lot of the questions may have been answered already if we take a close look at the charts that have already been shared, but let's talk about quick reversals and trend first.
Yeah. I mean, look, there's a great research note that just came out from Quantica that people don't subscribe to their research. I highly recommend. It's a managed futures manager out of Switzerland that highlighted that when you look at the performance of trend, what you tend to find is that trend's performance is really strong, not when you have returns coming from a lot of uncorrelated diversified sources, but rather the correlation within sectors tends to get much higher, right? So we saw a really strong performance from the metals. It wasn't because gold and silver and copper were uncorrelated. It happened to be a period of high correlation between them that was very strong and persistent. And so one of the arguments is, well, trend following might be actually getting compensated for taking on that extra correlation risk during those periods. And you see that that's a persistent feature in all markets, whether you're looking at the equity sector, the bond sector, the metal sector, the energies, or the agriculturals. And so, right, the point here is like almost by design, if equities are persistently strong, trend following is going to step into that. And yes, like again, trend following is up about forecasting in the sense of like, if the trend is strong, we're not sidestepping the next day because the trend is so strong. You're just going to stay with it, and you need to wait for the trend to roll over before you move out. Now, there are some risk management features you can embed, right? Both in like the VAR, total downside risk you're capping yourself at, both at the position and sector level, notional exposure caps you can put yourself at. There's all sorts of, volatility targeting can help with some of that, but I actually think it's sort of a feature. Like if you want to get all the beneficial, historically, if you want to get all the beneficial returns that the equity sector provided to managed futures managers, especially trend followers, you just needed to accept that there was that other sort of like shoe that would drop eventually and equities would sell off and you'd eat the first part of it. And then most of the time, that's where you're massively cutting your risk.
Yes, and I'll address a couple other questions as well. One of them was, are there limits to your equity exposure in these ETFs? And the answer is yes. It's 100% long or 100% short, which ends up, we do this for every one of the sectors, and it's about understanding, what a certain percentile above that exposure does it add value to the strategy long term or not, and do we want to take that risk? So every sector has a limit. For equities in particular, it's 100% long or short. And I just want to address on the carry side.
I just want to add, sorry, Rod, I want to make that very clear. That's on top of the 100%.
That's right.
Equity base, right? So we can be 200% long or flat or net zero when you include the base.
Okay. Corey, if you wouldn't mind letting me just turning off your screen so I can share. Corey's already alluded to this before, but by the way, if you guys want to do your own research on this and take a look at the history of allocation across RSSY and RSST, you can go to the website and scroll all the way down here. And what you'll find is a transition plot over the last 12 months. And one of the interesting things about this idea that is, if stocks have been on a run, will carry have negative convexity? Well, not necessarily, especially in a period like we've seen in the last, say, 9 months, where carry has been net short equities, right? This wouldn't be, and it hasn't been the case recently, right? It's been, as we've had a pretty rough quarter, carry has done well, not just because of equities, but because of all the long positions and energies and so on. When you contrast that with, this is now the transition plot for trend, trend by design is long equities quite a bit. And so it makes sense that if it's got an oversized allocation in equities because it's in a positive trend, it's more likely to have that reversion. Hence why the combination over time makes sense.
Rod, can you go back to the carry transition plot though really quickly? What I do want to point out is, like, again, that was a period of very strong equity returns coming out of the tariff tantrum. The total risk exposure to equities there is quite small, right? So we talk about, yes, maybe it was on average short from, July 2025 there through March 2026, where then it started getting more short, but it was only slightly short versus trend, right, was significantly long. And so even though their signals disagreed, again, going back to my point about like the disagreement charts, trend was very, very long. Carry disagreed, but it only was slightly short. It wasn't super convicted in its short, which is very different. And that's why these things don't just completely net each other out.
And a related question on performance is whether carry following a poor performance period is likely to have a really good performance period. We've done work on that and tried to assess whether there's a signal there. And the answer is no. The returns seem to be idiosyncratic. If there's been a period of massive underperformance, there's no way that we can tell whether the next 3 to 6 months are going to be great. We have a sense that over time it makes money, and sometimes it's really fast. Sometimes it's slowly it recovers, but no real signal there on our end, unless you want to add something there, Corey.
Other than if we could market time it, we'd market time it.
We'd be market timing it. Yeah. Similar with trend. It's like, can you trend follow trend following? The answer is so far, no. Another question was about margin. There's a few questions on margin. So the first question is whether there's relatively more margin call risk between one and the other. I did some work on it while the presentation was being done. And look, on the medium margin requirement for both of these strategies from 2000 to now is lower than 12%. So it's already very low, and they're really, this is something that we've addressed in a blog post here that that's called margin management and return stacking, because there's a lot of initial thoughts about if there is a crisis, you guys are going to see your margin requirements go up, and what's the danger there? So we can address a theoretical example of margins go way up. What do we do? And I think, Corey, you should talk to the mechanics of that. But I think the headline answer here is what we see live because of how these strategies are designed and how risk is managed. We tend to see when there's markets in chaos, margin requirements tend to actually go down. And so this is an article, this is a kind of little chart showing the rolling margin requirements of, I think this is trend.
Yep.
And you can see here highlighted in the COVID crash, the 2023 banking crisis, the tariff tantrum, that in all three very acute market stress scenarios, what we tend to see is margin go down. And this is a combination of, hey, things are going against you, trends are reverting, volatility spiking, and all of those are risk management measures that the system already has embedded in it. So we will get a reduction of everything. Gross exposure tends to get lower, and with gross exposure getting aggressively lower, there's less margin required to continue to implement the strategy. So I think that the key takeaway here is in acute instances, historically, what we have seen is that margin requirements tend to attenuate rather than increase.
Yeah, and just on top of that, right, to go to the question of what happens if and when we were to get a margin call, right, we try to hold an excess of cash, right? So we have the margin posted explicitly, and then we have a whole bunch of cash that we keep around in excess of that we can quickly wire over. And then sort of beyond that worst case scenarios, we can, with most of our partners, we can in theory move equities over as collateral if necessary, or right, we can sell down our equities and move more cash over. So there's a variety of steps here, but as Rod points out, we tend to hold an excess of a meaningful excess of cash versus even our 99th percentile margin requirement. And during those crises that everyone thinks we tend to need the most margin, because that's when they hear about margin rates going up, that's when position sizes are often getting most aggressively cut, and our margin requirements actually historically, both in live and sort of simulated historical analysis, would have actually meaningfully gone down.
Yeah. Thank you, Corey.
Rod, can you go back to the transition chart? Because there's one thing I think you missed here, which I alluded to, which is that we recently added agricultural markets to both carry and trend. To carry at the beginning of the month and to trend just earlier this week.
That's
we
right.
added
So this is
3 grains and 3 softs markets.
That's right. Well, let's talk a little bit about some of the reasons why and the questions that we've been asked about that. So why have we decided to include those at this point in our life cycle?
Yeah, well, I mean, I think in both of them, the answer is typically more diversification is better than less. We think that both trend and carry have high efficacy in their signals when trading in these markets, and so we want to include them. Why haven't we included them in the past really just goes down to they are markets where there are more constraints from a capacity perspective. We recently took over trading of all of our futures contracts in these strategies. Historically, we used our partner firm that gave us some really nice economies of scale as our asset base was growing. Now that we're at 1.4 billion, we have the ability to in-house that. The team that trades it has been trading hedge fund strategies in futures markets for over a decade. And so they have an incredible experience trading these markets. And so now that we've taken it in-house and we gave that a full transition period, we were very comfortable adding these markets. We do generally expect it to have a bigger impact on average in the futures yield strategy than the trend strategy. The trend strategy is a replication strategy, and we find when we run the analysis to replicate the index, you just don't have as much exposure to these types of markets versus in carry. These markets are largely uncorrelated, so therefore they get a full risk weight just like any other market. And so the expansion from say 26 to 32 markets is pretty meaningful, both in reduction of risk exposure to the other markets, as well as the risk exposure these markets get on average.
We have a ton of great questions. I'm trying to make sure that we...
Honestly, we should just do a Q&A webinar. That's all. We get so many great questions during this stuff.
Absolutely. So let me go back to the some of the ideas behind what carry is and isn't. So we talked, you mentioned that trend is a trend replication, and so it shouldn't have much of an effect. People are asking questions, how do we do our trend following strategy? And then whether we're following a similar index on the carry side. A follow on to that, which I'll remind you if you forget, is why did it do so differently in 2025 than the Bloomberg carry index or whatever other index that people may be trying to find that has the name carry in it. So what's the difference between one and the other?
Well, the trend strategy, and Rod, can you actually scroll up a bit here because there's a scatter plot I'll talk to. The trend index, right, is a trend strategy is a replication strategy that is trying to explicitly provide exposure to what we'll call trend beta, right? Where we're defining trend beta as being sort of the category average. So if you go out and you look at the biggest managers, the most liquid managers, and you average their returns together, what does that look like? What does the Morningstar category look like? What's the SocGen trend index look like? That's effectively the return we're trying to give you. And to do that, we use replication techniques. There's two that we primarily use. One's called the top-down, where these are statistical replication techniques, and the other is a bottom-up, where we're running a trend-following process, but all sort of the knobs and dials have been set so that that trend-following process tries to look like the composite behavior rather than having a particularly strong view of how trends should be done. And so what that means is when you add a market like the agricultural markets, if we find historically that those agricultural markets don't do a good job with helping explain the variance of sort of the composite average of managers, we're just not going to trade them a lot. We still want them there. They're still on the margin beneficial, and we like having the diversification, but it just means our system isn't going to give them the same full risk weight. Carry is its own unique thing. And one of frankly, the struggles we've had with carry is that there is no good index. Carry can be implemented in a lot of different ways. And I think a lot of people look towards that. What was the Bloomberg, Goldman Sachs carry composite is now just the Bloomberg carry composite. When you look at that index, it is going to give you, I believe, rates, currencies, and commodities. There's no equities in there. There's 3 sub-indices, and in each of those sub-indices, it's going to go basically sort all the markets by their carry score and then go long half of them and short half of them, which means you're running within each sector neutral, and then you're getting equal risk weight across those 3 sectors. Our carry strategy works differently in that you could, in theory, have the exact same measure of carry, but what we do is we don't isolate them within a given market. What we're going to do is we're going to have all the carry scores and then effectively say, how do we develop a portfolio that maximizes the aggregate portfolio carry score while targeting a volatility of 10%? And what that is going to do, that the key difference is it's going to take into account correlation both within the sectors and across the different markets. And so what we have here on this scatter plot, and again, this is updated live every day on our website, is on the bottom, the risk-adjusted carry score that each market has. And then on the y-axis, basically our risk-adjusted target weight. And again, this is modeled. This won't line up perfectly with the weights we have in the portfolio, but this is largely what we're targeting. And what you would expect if all these markets had zero correlation is that all of this would fall on a nice flat line, right? The stuff with higher risk-adjusted carry would get a higher risk-adjusted weight. The stuff with lower risk-adjusted carry would get a lower risk-adjusted weight. And you do generally see that. But what you find is that dispersion around that sort of perfect line comes from the diversification benefits that each market can give us, right? So I want to highlight one in particular, Rod. There's a slightly negative black dot up there that's positive. So if you go up higher than that, yeah. So that's the Nikkei. And you can see that the risk-adjusted carry is actually negative, but it's getting a positive weight. And it's likely getting a positive weight because of the diversification benefit it's bringing, even though the actual carry we're generating there is going to be negative, right? The optimization process we run is saying, well, actually, it's slightly beneficial for us to be positive there because it allows us to take more risk elsewhere because it's that long position's helping compress the portfolio volatility. And so that optimization process can make sometimes this a little bit confusing. Again, on average, we expect this to follow sort of a 1-for-1 line. The more carry, the higher the position weight, the less carry, the lower the position weight. But what it means is we can end up net long some exposures, net short some exposures. Like we can see we're generally just net long energies. We're currently just net short equities. We're generally net short the metals right now, right? Unlike the Bloomberg index that says, well, always half the metals are going to be long, half the metals are short, or half the energies are long, half the energies are short, or half the equities are long, half the equities are short. This portfolio will take active beta tilts in each of these sectors based on the carry and based on the effective diversification that can be delivered to the portfolio. And so that's going to cause it to look meaningfully different. But again, we think that those beta tilts are accretive over the long run to the return that can be generated by this portfolio.
Yeah, and I'll say that in the presentation, we lay out how trend is done, but also if you go to investresult.com and look up carry, there's a white paper that we've written on how we think about carry. It's not exactly how we do it in the ETF, but it gives you a better understanding, deeper understanding of how we're doing things. I know we're coming up to the hour, but there's still a ton of questions. So if anybody wants to stick around, please do so. I think this is an important one. A team that's thinking about adding 10% to carry, 10% to trend. But we've highlighted RSST and RSSY. A lot of people are dealing with pregnant gains and substituting right now those to get exposure and stacks of trend and carry is going to hurt from a tax perspective. And the question is whether we feel that it's as accretive to use our B series, so the bond stacks, in order to get exposure to these. And yeah, the answer is we are coming up with that a lot. And there's a lot of people right now seeing losses in their bond portfolio after a few years of bear market that are choosing to allocate to RSBT and RSBY in order to get those exposures. So the benefits of that obviously are better for the clients short term, but ultimately long term, having those stacks, whether you're doing it through stocks or bonds, are going to be the same strategy. Now, a caveat there obviously is we always talk about the benefit of return stacking tends to be the line item risk aspect, right? So when you're grabbing something like trend following or carry that has average standard deviation volatilities between 10 and 13%, and you match them against something like equities that also happen to have volatilities between 15 and 20, depending on the year and decade, then that offsetting mechanism actually works really, really well. You're getting a good rebalance, you're getting volatility being dampened, the line item risk seems to be lower. When you stack them on top of bonds, which tend to have volatility profile of 5 to 6%, and you're stacking trend and bonds, again, from a portfolio construction perspective, from stacking carry and trend on top, same thing. From a line item perspective, you're just going to see those securities be dominated more by the carry and trend volatility rather than the bonds. So just kind of a caveat there on the use of the bonds. So it's very idiosyncratic and it's going to be on a per client basis. Okay, there is just a couple more if you're okay with it going over a little bit, Corey.
Of course.
So one of a few questions that have been asked a few times, and I'm not surprised on the trend side, is why are we adding more markets? Isn't it more accretive to just kind of simplify and reduce the amount of exposures that we get to trend if we're doing replication, given that most of the benefits we see in commodities, for example, come from bonds and copper. So what are your thoughts on that?
I'm not sure I fully understand the question. Like, it's
Well, the
better
question
to-
is, we've added markets,
Yep.
and there's a lot of trend following managers that are talking about simplicity and the benefits of simplicity, and how adding more markets may make it worse, and having less markets tend to be better. You get most of the benefits. You're just better off doing it that way.
Yeah.
That's basically the question.
Yeah. So we agree with a lot of that analysis, right? So when we run our models, it's exactly why we don't end up with the same risk weight and things like the ags when we were building our underlying trend model. It's to do the replication, you just don't need much exposure there to capture the breadth and the thrust of the trend sort of composite, or, whatever you're building there. Most of it's driven by just like equity beta and the euro and the yen, the 5 and 10 year US Treasury, oil, gold, like that captures a lot of it. But it doesn't capture all of it, right? And so the question is, how dialed close do you want to get? There are certainly replication strategies out there that have done a great job, but the tracking error is still quite high. To date, that tracking error has been beneficial for a lot of it. And like we see that in what we call our top-down small methodology, where I mentioned we have these bottom-up and the top-down approaches, the top-down being purely statistical. We run a small universe statistical approach, and it has done quite well. But it also, I think, has the largest tracking error to our category of any of the approaches we have. And our objective, as much as I hate following the lemmings off the cliff in something like the taper tantrum, our objective is to deliver the trend category returns. And so what we find is that, like when we were exploring adding these agricultural markets, is that they do marginally improve over time our ability to fit. It's not as big, like, again, if I just took out oil and like both Brent and WTI, that would have a much bigger impact than adding all the ag markets, right? That single market. But once you have all those big markets, it then becomes a question of what can you marginally add. The last thing I'll add is, like, again, the way we do replication is the vast majority of the return from the process comes from this bottom-up trend following strategy. And as much as we, again, try to tune it so that it gives the category average, there's inherently nothing that says that it has to give the category average. And so we like the fact that it is inherently then a trend following strategy. It's still going to be mechanically tied to trend following, but if and when it does deviate, there's a lot more comfort in having some diversification there than less diversification. It can be the case that, like, again, I think this maybe accentuates it. Like Brent and WTI are very, very highly correlated instruments. If you were to say, let me run a 10 instrument trend following strategy and just run very naive signals, there is a case where you could get whipsawed in Brent and not in WTI and vice versa. And even though they're very highly correlated, you end up with a huge dispersion in the actual returns your program achieves. Diversifying even across like semi-correlated stuff can still bring a big benefit from a process consistency and outcome perspective.
Yeah, no, that's well said, Corey. And another question that has come up is, by adding carry, doesn't it dilute the convexity nature of trend during equity market routes? And I that's something that comes up a lot. And it's a tough question. It depends on what you mean by acute market and what, how long that market route occurs and where the futures yield or carry exists across the curve in every one of those markets. It's almost like an unanswerable question, but empirically, when you look at periods like 2008, when you look at, live performance from what we've done in 2022, for example, right? Both trend and carry made positive returns that year, but they happened at different times across different markets. In 2008, in testing, we see a similar thing. Carry had a positive year, but at different times. Like we've seen an acute drop in equities here this year. Trend didn't do so well, and carry did. Now, is if we see an exact same scenario 2 years from now, is the outcome going to be the same? It's going to be different because the term structure is going to be different. And so what I always give as a takeaway is carry and trend have the ability to provide non-correlated positive returns during equity market routes. They both have the ability to provide negative returns during negative market routes, depending on positioning. We saw that in 2025. The way I feel investors need to think about this is, are these unique sources of return that have a risk-based reason or behavioral finance reason to exist? Are we expecting returns above cash, and should be holding for the long term? And are they non-correlated to each other to a good extent, and non-correlated to equities and bonds? And the answer to all of those is check, 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 check. Yeah, we do believe that to be the case. And it's tough to really give you up front when one thing is going to have convexity and the other one's not. There's been a lot of convexity to carry this year.
The only thing I'll add to that is having looked at these historically and run a large number of simulations, if you're running an optimization process that says, well, let me create an overlay that helps reduce the maximum drawdown of my stock bond portfolio, and you include all sorts of assets like trend and carry and merger arb and gold and all sorts of stuff, like you typically, if you only care about limiting drawdowns, you tend to end up close to an equal weight of trend and carry. If you care a lot about generating consistent excess returns, you end up with a mix of gold and merger arb and trend and carry. But when you run all sorts of simulation analysis, like there's no denying that carry has historically performed well in a variety of different equity market routes. And so just from a diversifying your process perspective, it does seem like it tends to complement trend quite well.
Yeah. Look, there's a ton more questions, but we're 10 minutes past the hour. We'll see if we can write some blog posts out of these questions. And maybe you're right, Corey, we should do just a general Q&A in the next month or so. Maybe probably something we can do for next month. But before we leave, a lot of these concepts we've spoken about them, they're theoretical. Go and do some of your own work on how stacking could be beneficial to your process, to your portfolio. If you go to returnstack.com, you'll find there that there is a visualizer, a simple visualizer that we have put together for you to explore and get ideas and understand what it means, the benefit, the pros, the cons, the drawdown profiles, the tracking error. It's all there. And if you have any questions, you can, from that widget, request a portfolio review to talk with one of our product specialists. And that's really what we're good at. We actually are good at partnering up, getting to understand exactly what your needs are, helping you put together the right stacks that make sense for you, your values, your team, and your clients, and then kind of working together as a strong partnership going forward. So please do visit that site. And it's returnstack.com/portfolio-visualizer, or just go up here to tools. Anything else you want to share, Corey, before we leave?
No, I just want to thank everyone for tuning in, sticking with us during a little bit of a power outage and us working through this. I know this was some heady stuff, but it's always a great opportunity to educate. I know we've had a lot of eyes on our outperformance. We don't want to overstress short-term returns, as Rod pointed out, but I think it does highlight the whole goal of return stacking, which is adding uncorrelated diversifying return streams on top of the core equities or bonds that you know and love. And certainly, again, we're showing 100 portfolios. That is not how we advocate for their use. And so, as much as our team can be a resource to you to help you explore these ideas and how they might fit within your portfolio, please reach out.
Thanks, everybody.